Good morning. This is Professor Marsh again, and this is Principles of Financial Accounting at Newberry College in the spring of 2022. This is the second and final lecture for Unit 4, which is about the adjustment process and adjusting entries. In the previous lecture for this unit and this chapter, we discussed some of the, I guess you would call it the accounting principles behind adjusting entries. And now we're going to get into the recording and posting of the common types of adjusting entries. So we're going to begin with section 4.3, which is titled Recording and Posting the Common Types of Adjusting Entries. And if you will look into your book, you will see that the book has a little bit of discussion of the techniques of adjusting entries, and then it has some basic rules for adjusting entries and posting them. And then it's got many examples. And so the way that you do this is to read the theory and then do the examples, follow the examples, go through each of the adjusting entries that are listed for this particular unit. They're using again the example of the Printing Plus company. And it's got the month of January and all of the entries for the month of January 2019. And so please take a look at that, work your way through that, maybe make some notes, look at how the journal entries are done, look at the impact on financial statements for the various transactions, and read the analysis. And this will give you some experience in this, and then you can reinforce that experience when you do your homework for this chapter and when you take the quiz. So this will bring you back to this material. And of course, the homework and the quizzes are all open books. So nobody's trying to play hide the ball here, but this is important for you to actually, get your hands dirty a little bit and get in there and maybe take out a pencil or pen and show yourself how to make these entries and then practice them. Now, the rules for adjusting entries are as follows. A, every adjusting entry will have one income statement account and one balance sheet account. Okay, so that's it. That's one of the principles. 2, cash will never be in an adjusting entry. And 3, the adjusting entries, or C, I guess I should say. So A, every adjusting entry will have one income statement account and one balance sheet account. B, cash will never be in an adjusting entry. And C, the adjusting entry records the adjusting entry records the change in the amount that occurred during the period. Okay, so again, this is accrual basis accounting. And so, we have all the cash transactions in the journals already. We record those as the cash transactions occur. But this is getting to the end of the period and then looking at some of the accrued assets, the accrued liabilities, and seeing if they are still accurate or perhaps they need to be adjusted to the current values and to record any income, any revenue or any expenses for the period that would affect those amounts that were set up as assets or liabilities on the financial statement in the past. So in posting adjusting entries, Posting adjusting entries is the same process as posting general journal entries. You just make a journal entry, and the additional adjustments may add accounts to the end of the period, or it may change the account balances from the earlier journal entry step in the accounting cycle. So, just understand that the income statement accounts, okay, you're going to have one income statement account. Those are going to be the revenue or expenses accounts. So revenue or expenses will affect the income statement. And then you will also have a balance sheet account. And the balance sheet accounts are assets, liabilities, and stockholders' equity. Those accounts will be affected by these adjusting entries. And as I said before, cash accounts always will have journal entries. So when you have a cash account transaction during the period that goes into your general journal, there will already be an accounting for that, for that transaction. So there's no need for an adjusting entry for the cash accounts. If we find anything, if we find ourselves in a situation where the cash account needs to be adjusted, that type of adjustment is called a correcting entry. It's not an adjusting entry, it's a correcting entry, because we must have made the wrong entry to reflect the cash transaction if we get to the end of the period and we have to adjust the cash account. So that's a correcting entry versus an adjusting entry. Now, there are many, many examples of adjusting entries. In your book, you have the example of the supplies account. So you go to the supplies store, Office Max, Office Depot, Staples, whoever, and you buy $300 in supplies when you set up your business. But then you find at the end of the period that the workers in the business have used a lot of those supplies, and there's only $100 of supplies that are left in the supplies inventory. So what type of entry would you make to correct the balance that's in the supplies inventory account? Well, you'd have a $200 debit, okay? The inventory of supplies, you've taken actual physical count, or you've used some other convention to estimate what supplies are left. So you have a $200 debit to supplies expense. That is the income statement account. So $300 in supplies down to $100 that you have left at the end of the period. That's $200 in expenses for the supplies that were used. And then you would have a $200 credit to the supplies account, the supplies inventory account. So you would reduce the asset by making a credit entry for $200. Remember that an asset account, the normal balance is a debit. And so to reduce that account from $300 down to $100, you would make a $200 credit. And then your offsetting debit entry would be an income statement account, and that would be the expense account, supplies expense. Normal balance and supplies expense is going to be a debit. Expenses on the income statement are debits. So that's how you would make that that type of entry. Now, so that's that is a the supplies account is a sort of an asset account. Now, how would you deal with a liability account? Unearned revenue is a liability. So if you have a customer who's made a prepayment, so let's suppose we had $500 at the beginning of the month in our event business or catering business or whatever it is, and we had an event that was a $250 fee that we earned during the period, then we would already get what we would do is we would debit unearned revenue. Okay, so unearned revenue is the liability account. It's a balance sheet account. We would put a debit against the unearned revenue and reduce it by $250. That would, you reduce the liability account by making a debit entry to the liability. So that would drop the unearned revenue account from $500 down to $250. And then we'd have a credit to fee revenue for $250. Because we hadn't recognized the revenue when we got the cash, we're recognizing the revenue now that we have earned it by holding the event. And so those are two very common types of adjusting entries. Let's go on to the next section. And you can see, well, before we go on to the next section, you can see all the different types of adjusting entries that we have here. So, just to look through, you see the example of the supplies expense using the supplies. There's an example of depreciation expense. So you see depreciation expense, and the entry to record depreciation for the period is to take an expense, depreciation expense, which is an income statement account, and you take depreciation expense on equipment. You can see in your book that there's a $75 entry for the month's depreciation on this equipment, and then you have a credit, and the credit actually goes to, it's not really a liability account. There is a convention or principle that we keep a contra account for accumulated depreciation. So the asset is equipment, and then underneath equipment, on the asset side of the balance sheet, we have a contra account, and that's where the credit goes to equipment for $75. So the balance sheet account where we have the credit entry is an accumulated depreciation. And what that will do then is whatever we paid for the equipment, its book value will be reduced from its original cost by $75 when we book that credit entry to accumulated depreciation. And you can see that right there. And then the book also shows you the effect of the various transactions on the accounting equation. So assets equals liabilities plus stockholders' equity. In the case of this particular entry for depreciation, we are reducing assets by $75 because of the contra accounts increase, and then we are also reducing stockholders' equity by $75 because that goes to stockholders' equity through the income statement. It is the income for the period is going to be a component of retained earnings, and so the $75 expense reduces the income for the period and also will reduce retained earnings, which reduces stockholders' equity. Okay. Then there's an example of the unearned revenue. That's like the catering event or that we just talked about. And you can see the entry for that. Another example is interest. So you have a note receivable that is earning interest, and or perhaps it's a savings account in the bank, and you get a statement. You don't have a cash transaction that is in your journal, but you know that the bank has credited your account with $140 in interest. Now, it would take a lot of money at the bank to get $140 in interest for the period these days with the way interest rates are on bank accounts, but perhaps this journal entry was prepared during a time when rates were somewhat higher, and they're probably going to be moving higher in the next few years. But for this particular company, for the printing company, they must have a lot of cash at the bank, and they have earned $140 in interest revenue. And so what you do is the balance sheet entry is to put an account on the balance sheet, a receivable called interest receivable. That's an asset, and then also to make a credit entry to interest revenue, which affects the income statement. So that's and you can see when you make these journal entries, you can see that we have a date for the journal entry. Many times when we actually do our journals, we're going to have our chart of account numbers associated with these various accounts. So you'll also have that typically in a real journal. This is a simplified journal entry to show you as students how it's done. But in practice, you will have the chart of account number. So, as an asset, remember those are typically in the hundreds or thousands depending on the size of the business. And then revenue is typically a 400 or 4,000 series account for the interest revenue. You'll also typically, in a real accounting system, you will have a transaction or entry number. So each of these journal entries will have a discrete number, typically a sequential number that is associated with it, so that it can also be searched and it provides an audit trail for the auditors. So you'll have the date, you'll have the chart of account numbers, and you'll oftentimes have a transaction number as well for these adjusting entries, as you will for all your journal entries. So then we've got the salaries expense. We've accrued some salaries that aren't going to be paid until February perhaps, and so as of January 31st, we're going to book an expense, the income statement account for salaries expense, and then also an offsetting entry to salaries payable, which is a liability expense. And again, your book does a good job of showing you the effect on the accounting equation in that you're increasing a liability, but you're decreasing stockholders' equity, but it preserves the equality of the accounting equation because 0 equals plus 1,500 plus minus 1,500, that equals 0. They knock each other out. So that's a example of that. And then the book goes into showing you from the journal entries how to post those journal entries into your T accounts, and those are also very helpful as part of learning sort of the nuts and bolts of this. And you can see more and more complicated examples as you get down into the T accounts for revenue and service revenue and things of that nature. So there's if you work your way through all of that and you see how these all relate to each other, and then you get down to the T account summary, and this is I think a very helpful explanation of the adjusting entries, the month-end entries that are used to account for items that don't go through the cash accounts but need to be accrued at the or perhaps deferred at the end of the month to accurately reflect income and expenses. Okay, let's move on to section 4.4. At this point, what the book is doing is it's showing you how to use the ledger balances to prepare an adjusted trial balance. So we looked at the trial balance back in the previous unit, and now we're looking at an adjusted trial balance, and you can see how the adjusted trial balance is prepared, and how the additional accounts which are set up to reflect the accruals and deferrals are shown in the trial balance. And happily, when you look at the example of printing plus and its adjusted trial balance, it still balances. If it doesn't balance, then it points out that you've got some errors in your journal entries, or perhaps in transferring them to your T accounts, and so you need to go back and just check your work. And remember, we did have a unit before on troubleshooting. Remember that if you have a number that's easily divisible, when you divide it by 2, it looks like one of your entries. That's an example of perhaps an entry that was put on the wrong side as a debit or a credit, or perhaps one that was omitted if it's just the amount of one of the entries. And then if it's divisible by 9, there's a good chance that it might be a transposition. Now, with computerized accounting systems, transpositions don't happen anymore. Transpositions were very common when I was coming along in a world without personal computers and without QuickBooks and some of the other programs that are even more sophisticated than QuickBooks. But now that we have computers, hopefully we won't have as many transpositions unless maybe the computer has a virus or just having a bad day or something of that nature. But anyhow, so the adjusted trial balance, it lists all the accounts in the general ledger, including the adjusting entries which have non-zero balances. And this trial balance is an important step in the accounting process because it helps to identify any computational errors throughout the first 5 steps in the cycle. And I do think that the example of printing plus and how the adjusted trial balance is still balance despite all of the adjustments in section 4.3. And note the think it through note, the cash versus accrual accounting. I have posted a link to the accounting lectures at the Khan Academy in your materials, and I would like for you to go look at them. It only take, I think each of the lectures is maybe 5, 6, 7, maybe no longer than 10 minutes. And it explains cash accounting and then accrual basis accounting, and then there's a third one that talks about the differences between cash and accrual. And I think that these lectures are probably as good as you will see in a short time to explain the differences between cash and accrual for those of you who may still be having issues with that concept. And I think you'll find it very helpful. And you may also want to stay at the Khan Academy and look at some of the other materials they have. I think it's a wonderful resource. It's free. It's on the internet. It's very professionally prepared. And quite frankly, if you have gaps in your math education, it is incredibly useful. And I learned about it from one of my clients who had a child that was on the the autism spectrum, and the Khan Academy is really a judgment-free way. A lot of times autistic kids or Asperger's kids are very sensitive to nonverbal cues. A look of disapproval or disappointment oftentimes can really ruin their day and can trigger a lot of really self-harm type behavior, or perhaps lashing out at others. And so the Khan Academy is really judgment free. When you do the math lessons, when you do the exercises, you either get them right or you don't. And if you don't get them right, then there's a link to an explanatory video that explains what the mistakes might have been, or how to correct them. And then you can take it again, and you take it again, and when you get it right, you get points, and when you get enough points, you get badges, and it's kind of like the Scouts or something. But it's a lot of fun. I think at one point in my account, I had over 1 million points. I think I've lost some over the years as the website has been restructured. I think it shows me with a balance of somewhere around 800,000 or 900,000. But in any event, I'm not too concerned about that. But I do know that I oftentimes will brush up on my own math skills by going back and looking at, if I've forgotten about how to do linear regression, or if I've forgotten, for accounting, when we're looking at the accounting equation, just manipulating equations is an important thing. The way you subtract the same amounts from both sides so that you keep the equation equal. Or how you line up everything on one side, so that it equals 0. I mean, that's another way to manipulate equations. X plus y plus z, equals 0, and that's that's also a helpful thing to know and to remember, because it can save you a lot of time in doing your homework and trying to figure out, what's the missing variable in an equation. So in any event, I do recommend that to you, and I think there's going to be an extra credit question that will use that, and I think it's actually a 10-point extra credit question that will be on your quiz with respect to the Khan Academy. So take a look at that. Now, section 4.5 we're going to get back to in Unit 6. The last step in the adjustment process is preparing financial statements using the adjusted trial balance. And so those financial statements, remember, are going to be the income statement that shows the net income or loss as a result of revenue or expense activity in a period, the statement of retained earnings, which is important to, it's kind of a hybrid statement where you take the beginning balance and retained earnings and you adjust it, showing the effect of income or loss for the period, and also dividends or distributions on the earnings that the company retains. And then the balance sheet, which visually represents the accounting equation. It shows that the assets balance with the liabilities and the equity. And so those are the three financial statements that are typically prepared using the adjusted trial balance. We're going to forget about the statement of cash flow for this unit. We'll get back into that as we go along. And then there's also a discussion of the 10-column worksheet, which we're going to not talk about, but that organizes the data all the way from the original trial balance all the way through the financial statements, and can be very helpful in troubleshooting for mistakes, and also in financial analysis and preparing the financial statements. So lots and lots and lots of examples in the book, and if you look at at least browse your way through section 4.5, but understand that we will be coming back to this very meaty section when we get to Unit 6 and pull together our final financial statements. So in any event, I have been grading your quizzes and your homework, and I will be posting additional lectures. I know that there's one lecture review on quiz number 1. Some of you have gotten a little bit behind, and so I haven't released the lectures with the quizzes and homework for units 2 and 3, but I will shortly, and then also do the homework and the quiz for Unit 4. And we'll talk to you again very soon. With that, have a great day, and keep up with your work. Thanks a lot. Bye-bye.